And good afternoon, everybody. And yes, by complete accident, I think, my presentation follows on quite neatly from what Zlatan was saying, in that what I'm attempting to do here is, to some extent, quantify the opportunity from the point of view of potential suppliers into that Serbian growth story. So, disclaimer. An introduction to ourselves. You may very well not know who we are. Scan is a small consultancy business started 12 months ago by myself and my business partner Charles Cooper, who's also here. We have a long background as mineral economists. We're both originally geologists, but we've spent the bulk of our careers with some of the big research houses like Brooke Hunt, which is now Wood Mackenzie, GFMS, and S&L Financial at one time as well. We cover a really broad spectrum of issues. We do consulting work for suppliers, very often looking at market opportunities and sizing those for them. So this seemed like a good chance to put that to work. You'll notice our core commodity expertise does not include coal. And for that reason, or that being one of the reasons why I won't be discussing coal in this presentation today, we'll focus solely on the metallic minerals in question. I guess we've heard from many different people that there is a mining boom underway now in Serbia. Our starting point was the question: well, can we quantify that? I will caveat this whole presentation quite heavily in that there is a relatively limited amount of information available with regard to many of these big projects, particularly the Rio Tinto Jadar project. But we didn't think that ought to get in our way, so we've had a go anyway. And if anybody's got any better information, we're very pleased to debate that. But hopefully this will give people a good flavour of what we're looking at in Serbia over the next 10 years. So, from that starting point, we're going to go ahead and look at what the key projects are and start from the point of view of their basic technical economic parameters, their production rates, production costs, risk factors impacting them, build that up into capital and operating cost forecasts, albeit very early stage, high level ones, and then we're going to see what that implies for various categories of input. So that's essentially the agenda. But please do take those caveats to heart as we go through this. So starting off with growth in rock production. What we can see here is on the left-hand side axis, this is open pit ore and waste tonnages, so shown in the orange and yellow bars. On the right-hand side, we have underground, mostly ore tonnages. We don't really think much about waste tonnages with regard to underground mines. What we can see here then is we're forecasting that over the course of the next 7 to 8 years, we're going to see underground mine production in tonnage terms increasing from somewhat less than 1 million tonnes per year in aggregate on the mines we're looking at to over 3 million. And it will continue rising from that 2025 cut-off date that we've got here as some of these projects such as Timok and Jadar continue to ramp up. In terms of open pit volumes, the main underlying producer in this analysis is of course Bor, and of course later on, stacked on top of that, we have the Timok gold operation, which is tentatively slated to come into production around 2023. So those are the basic physicals that we're dealing with in the forecast. If we look at, this is kind of skipping a bit to the final conclusion in a way, but if we stack all this up and add together all of the capital costs and then add together all the operating costs, the point I'm really trying to make on this slide is that we are seeing really quite exciting market size growth if you are supplying into these markets. And obviously what we see here is the capital cost profile kicks in somewhat earlier and peaks around 2020, 2021 as the Timok projects and Yadar both really start to get underway. We've got annual peaks in capital spend on the population we're looking at here, somewhere around about $750 million, slightly less. And then as we get later into the forecast period, obviously these things are built. We've got ongoing capital expenditure just to keep them going, and some tail end of the construction. And then the majority of it is operating cost. So this is fairly typical of what one would expect in this sort of situation. What is interesting though is that we have a situation here in Serbia whereby several really substantial projects are all coming through the pipeline pretty much simultaneously. So this is going to be quite an exciting situation. If we break that down further and just look at the capital expenditure profile, what we can see here is ongoing expenditure right at the bottom there for ITB Bor, with a kind of a hump there, adding another $100 million a year for a few years as under the assumption that privatisation goes ahead in early 2018, $500 million of capex that's been required for some time in order to extend some of those mining operations and open up particularly some new open pits, gets invested over the course of that period from 2019 through to 2025. And then coming in on top of that, we have about $1 billion of capex for Yadar, which is the big blue block there. Assuming this thing goes away to the schedule that's been mooted, that would be peaking somewhere around 2022, 2023 as it's getting towards full construction. And then on top of that we have Timok copper, and on top of that Timok gold. And a very, very thin line on top of that for some of the smaller polymetallic base metal operations that we'll hear a bit about from Dominic, I'm sure. So that's the capital expenditure profile. OPEX comes in towards the tail end of the forecast period. As you can see there, we've got, this is a slightly different way of looking at OPEX to what I might normally present, in that very often in this industry we think in terms of dollars per tonne, or cents per pound, or dollars per ounce. What we're looking at here is aggregated up dollar million numbers, because what I'm trying to do is give a flavour for the size of the operating expenditure market, if you like. And obviously a significant proportion of operating costs is labour, manpower costs. But what we'll do on subsequent slides here is I'll show you what happens if you back that component out and then split that OPEX down into other components. Now, in order to arrive at these numbers, obviously I'm making some fairly substantial assumptions, particularly with regard to Yadar, but I think it's worth doing. With regard to the Timok projects, of course, there are preliminary economic assessments, or I think a PFS out in the case of the Timok Gold project. So we've taken the numbers from those as reported. In the case of Yadar, what we've done is we've formed an opinion on the scale of production based on the limited information that Rio Tinto have released. I think they've told us that they're planning on producing around 50,000 tonnes per year of lithium carbonate equivalent. And we're also assuming that this being Rio Tinto, it's going to be in the lowest quartile of operating costs, in that is one of the investment criteria, as I understand it anyway. So we get a reasonable handle on what we think Yadar's operating costs should be on that basis. So if we then take this and compare a split in those operating costs between 2017 and the population of mines we're expecting to be in production in 2025, what you can see is the operating cost base triples from $200 million annually to around $600 million annually. And as I mentioned, around 35% of that is actually labour costs. So backing that out, what we've then done is based on benchmark data that we've accumulated over the years we've spent in this business. We've looked at the scale, we've looked at the mining method, we've looked at what we know about process method, and we've attempted to split those input costs down into some of the larger cost categories. And in the background, although I'm not going to put slides up to show it, we've got around 36 cost input categories behind this, all of them benchmarked from operations that we've looked at over the years. Interestingly, there are some disproportionate increases in some of the cost components. Based on the analysis we've done, we're expecting that electricity costs will grow somewhat disproportionately to the rest of the input cost base. We're also overall forecasting a growth in the market for mining inputs and services of around 189% over this period to 2029. So the point really is that this is a real and substantial opportunity. Of course, on the assumption that these projects go ahead somewhere within the time frame that we're postulating. And one of the components of this analysis which would obviously flow from this is we would do a more rigorous analysis of what the actual likelihood of these things going ahead within the time frame postulated is. And with the analysis we've done here, we've not really put too much effort into nailing that down. We've just presented these things on the timescales that the mine owners are at the minute suggesting. So coming back to look at one of the projects from that point of view, we strongly suspect that the key issue with Yadar is most likely to be the market for its product rather than the technical feasibility of actually building the mine and operating it. And we strongly suspect with an asset that has potentially such a dominant role in a relatively small market, and as you can see from the slides here, we along with many other analysts out there, believe that there is going to be a genuine supply gap in lithium opening up over the next 10 years. And of course, Yadar does sit there in, amongst the top end of its peer group in the in the exploration, those projects which are undergoing exploration at the minute in terms of its grade and the amount of lithium that it contains. But the real issue, in all probability, is figuring out whether the market can actually, how much of this new material the market can absorb without negatively impacting the project's economics. So many uncertainties, but if all of these things do stack up together, we are going to see a very genuine boom. So in conclusion, it is a real boom. We've heard numbers bandied about previously of around $3 billion being required over the next 5 to 6 years, and we can actually corroborate that from the numbers we've put together. We're looking at almost 200% growth in market size for inputs, and some of those will be disproportionate relative to others. And that's it. Thank you.